specifically. William Lee is Chief Economist and Executive Director of the Milken Institute. William, good to have you on the program. Have you yourself raised, overall, there's no way to hard-code these numbers, but generally, do you think the final end-state tariffs will settle at over 15% now? William, what's your sense?
There's going to certainly be a permanent level of tariffs that everyone's going to face. I think President Trump has made that very clear. Whether it's 10%, 50%, that really doesn't matter that much, because I think the key to how companies are successfully able to engage with the United States is whether or not they invest and whether or not they open their markets to the U.S. Secretary Ludnick, everybody in administration has been saying, all we are looking for is for the world to open up their markets for U.S. companies, and we will open up ours similarly. And I think the level of tariffs represents a failure to do that. And I think the higher the level of tariffs that countries face reflects their unwillingness to open their markets. I think that's been the general rule of thumb that we've seen in the last several weeks.
And as these revenues are collected, it'll give more confidence, right? Annual estimates now that U.S. will collect additional new $250-odd billion in revenues. CBO, and perhaps that number goes up. Yeah.
Exactly. CBO came up with an estimate a while ago that said that given the minimal level of tariffs of 10% and some of the specific tariffs that are in place, they're anticipating revenues on the order of $2.5 trillion over the 10-year period, which is not counted by the CBO in their scoring of the tax revenues that are used to offset the deficit. So these are significant revenues when you come to think about how much the U.S. Treasury is going to have to borrow in the future with all the lack of success in closing the deficit that we've seen in the legislation so far. These tariffs will play a big role, even though they're not counted in the legislation so far.
Mm-hmm. Now, William, what about the other markets that investors are looking at this point in time? Japan, pretty significant because of the election results. Here in India, we're tracking earnings, some of them so far looking pretty okay. So how are some of these larger Asian markets looking to you? And of course, China continues to move along as well.
Well, China's got their own problems, their domestic problems. They are, in some ways, their own worst enemy because they really can't get the domestic economies going. The electric vehicle industry, which is where China really is absolutely supreme in in introducing the new technologies, they're killing themselves in China over excess competition, trying to lower prices to knock each other out. And so we have essentially price deflation in China. In part because there's lack of demand, but also because the companies themselves are trying to knock each other off. And I think the government, as you mentioned earlier, is trying to put some order to that, but we have yet to see that. The rest of Asia, the political unrest in many of these countries has really been a cloud over a lot of the investment potential that U.S. investors and other foreign investors would look at these markets. And as far as India is concerned, I think the question really is the big one that has been asked over and over again. Will India open up its markets for the U.S. and avoid the higher tariffs that are about to hit them? So I think the Asia-India complex of possible investments for global investors really depends upon how the governments will view protectionism and whether they really want to protect their domestic industries or are willing to let capital flow out of the countries, invest in other parts of the world, especially the United States, and that will lower the tariff barriers immediately.